For the last year, politicians and central bankers have been taking victory laps. They've been bragging about a robust labour market, a resilient consumer, and a booming economy that defied all the odds. But the receipts just dropped, and it turns out it was all a statistical mirage. A massive, quiet revision by the Bureau of Labour Statistics just revealed an 88% collapse in job creation. The truth? The US economy only created a dismal 15,000 jobs per month in 2025. And it actually shrank for several months out of the year. The government has been systematically overstating economic health, and now the illusion has shattered. So today, we crack open the real jobs data. We explain how these massive revisions happen, how phantom jobs are created out of thin air, and reveal why this hidden recession is about to hit the stock market like a freight train. My name is Nick, and you're watching Coin Bureau Finance. To understand the sheer magnitude of this statistical illusion, we first have to look at the numbers the media sold you versus the reality the government just quietly admitted to. Throughout 2024 and 2025, every first Friday of the month, the Bureau of Labour Statistics, or the BLS, would release their jobs report. And almost every month, their headlines had been glowing. The economy was supposedly adding hundreds of thousands of jobs, proving that the Federal Reserve had achieved the mythical soft landing. But on the 11th of February 2026, the BLS released their final benchmark revision for the period of April 2024 to March 2025. And the numbers were an absolute bloodbath. To put that 88% drop I just mentioned into perspective, it was the second largest negative adjustment on record, sitting only behind the 902,000 downward revision we saw in 2009 during the depths of the Great Recession. But that's not even the scary part. The scary part is what the revision does to the annual averages. In 2024, the US economy added roughly 1.45 million jobs, which averages out to about 122,000 jobs a month. Prior to this revision, the BLS claimed that total non-farm employment in 2025 expanded by 584,000 jobs, or roughly 49,000 jobs a month. A slowdown, sure, but still positive growth. But after the final revision, the official BLS release states, quote, "Payroll employment changed little in 2025, adding 15,000 per month on average." Let me repeat that. 15,000 jobs a month. When you compare the 122,000 jobs a month in 2024 to the 15,000 jobs a month in 2025, you are looking at an 88% collapse in job creation. Now, an 88% collapse is not a rounding error, but a fundamental misrepresentation of economic health. And when you dig into the monthly breakdown, the picture gets even darker. According to the official BLS Table A, January 2025, which was previously reported as a gain of 111,000 jobs, was actually revised to negative 48,000. The economy literally lost jobs, and indeed every single month in 2025 saw negative revisions. And the only reason the annual number stayed barely positive is because 134% of all net new jobs in the year ending March 2025 were in government, healthcare, and education. Without growth in those three specific, largely publicly funded categories, total employment in the entire United States would have been negative for the year. In other words, the private sector is flatlining. Manufacturers cut 68,000 jobs, while trade and transportation shed nearly 60,000. And this is why the economy feels terrible, even when the news says it's great. Your lived experience is correct. The data is wrong. But how does the government get it so spectacularly wrong in the first place? How do they hallucinate nearly 1 million jobs that do not exist in reality? Well, to understand what's going on, we have to look at how the sausage is made. And the primary culprit here is something called the birth-death model. The BLS calculates the monthly jobs report using a survey of existing businesses called the Current Employment Statistics Survey, or CES. But there is a glaring problem with surveying existing businesses. You can't survey a business that was just born today, and you can't instantly survey a business that went bankrupt yesterday. And to bridge this gap, the government uses a statistical guess called the net business birth-death adjustment. They look at historical trends and assume that in any given month, a certain number of new businesses are opening and creating jobs, while a certain number are closing and losing jobs. And in a normal, stable economy, this model works reasonably well, but it completely breaks down during economic turning points. Imagine your favorite local restaurant. You assume it's open today simply because it was open last year. But if you actually drove past it, you'd see the building is empty, the windows are boarded up, and the owner has gone home. The BLS model is driving blind. It assumes the restaurant is still open because the owner didn't explicitly call the government to tell them they went bust. And there is actually a perfect real-world example of this. When a small business owner named Molly Hutton decided to close down the cat cafe she owned in Buffalo, New York, she didn't call the BLS, and she told reporters, quote, "Honestly, I have no idea if I was supposed to do that." Multiply Molly by hundreds of thousands of small firms dying in a high interest rate environment, and you have a recipe for a statistical disaster. Because the government's model assumes constant historical growth, it hallucinates hundreds of thousands of phantom jobs that do not exist. And the data proves this. We actually have two different surveys which measure employment. We have the establishment survey, which counts total jobs and is heavily distorted by this birth-death model. And then we have the household survey, which actually calls real human beings and asks them if they're employed. For the year to date, through mid-2024, the establishment survey claimed the creation of 1.2 million jobs. But the household survey, which does a much better job of measuring reality at small and mid-sized businesses, saw a decrease of 100,000 jobs over that same period. And to make matters worse, the establishment survey's total response rate has absolutely collapsed. It averaged just 43% in the 12 months through March 2025, down from nearly 61% in 2016. The government is guessing more and measuring less. And even the jobs that do exist are painting a grim picture for the American working class. We are witnessing a massive structural shift from full-time careers to part-time gigs. As of December 2025, 17.5% of total employed workers were part-time. In July 2025 alone, the number of full-time workers decreased by 440,000, while the number of part-time workers rose by 247,000. Employers are swapping high-paying full-time jobs with benefits for low-wage part-time roles to cut the costs. The USEX measure of unemployment, which includes marginalized workers and those forced to accept part-time instead of full-time jobs, ended the year at 8.4%. That is more than 2% above pre-pandemic levels. So, the labor market isn't booming, but bleeding out badly. Now, before we connect these dots to the Federal Reserve, the stock market, and the terrifying reality of consumer debt, we need to talk about your financial safety. Because you simply cannot base your investment strategy on manipulated government headlines. And if you were trading based on these BLS numbers that added 500,000 jobs, you are walking into a buzzsaw. And the best way to protect yourself is to stay informed with unvarnished, accurate macro analysis. And that is exactly why you should subscribe to the free Coin Bureau Finance weekly newsletter. We break down the data the mainstream media ignores, and we give you actionable insights and what it means for your portfolio. And you can sign up to the newsletter right now by hitting the link in the description or by scanning this QR code on your screen. It costs you nothing, but in a market running on phantom data, it could save you everything. And now, back to the hidden recession. Now, when the data is this wrong for this long, it inevitably sparks a political firestorm. And in August 2025, that firestorm went nuclear. On the 1st of August 2025, President Donald Trump abruptly fired the Commissioner of the Bureau of Labor Statistics, Dr. Erica McAntifer. And this stunning move came just hours after the BLS reported a gain of just 73,000 jobs in July and revised the two previous months down sharply by a combined 258,000 jobs. Trump accused McAntifer, without evidence of course, of manipulating the jobs reports for, quote, political purposes. He explicitly claimed the numbers were rigged to make him look bad. Now, former BLS officials and economists pushed back hard. They pointed out that the commissioner has no role in producing these estimates and doesn't even see them until shortly before they're released. They argued that these massive downward revisions are not proof of deliberate political manipulation, but rather proof of exactly what we just discussed: the structural failure of the survey models when an economy is slowing down. As the former commissioner actually said herself, revisions this large happen when businesses are responding late to the surveys, quote, because they're just too busy trying to stay alive. But here is the brutal truth. Whether you believe this is a case of deliberate political manipulation or a case of systemic institutional incompetence, the end result is exactly the same. The data is broken, and that broken data has poisoned the entire global financial system, because there is one institution that relies on this BLS data more than anyone else: the Federal Reserve. The Fed sets the cost of capital for the entire world based on these exact, flawed numbers. Throughout 2024 and early 2025, the Federal Reserve kept interest rates pinned at a punishingly high 5 to 5.25%. Why? Well, because they looked at the BLS jobs report, saw hundreds of thousands of jobs supposedly being created, and concluded the economy was running too hot. They believed the fake strong jobs numbers, so they kept interest rates too high for too long. The Fed is driving a car looking in the rearview mirror, but the mirror is a funhouse reflection. By the time the Fed finally realized the labor market was cracking, the damage was already done. They issued their first cut of the year in September 2025, followed by another in October, and a final 25 basis point cut in December, bringing their target range down to 3.5 to 3.75%. But monetary policy operates with a long and variable lag. It takes 12 to 18 months for rate hikes to fully bite into the real economy, and the damage from those 5% interest rates is hitting an economy that was already shrinking. The Fed was actively applying the brakes while the engine was stalling. And to make matters worse, the Fed's December 2025 rate decision was actually clouded by a lack of timely data because of a 6-week government shutdown that literally halted the BLS data collection in October. They were flying completely blind, and while the politicians argued over who is to blame, the American consumer is suffocating under the weight of this policy error. And if you want to know what an 88% collapse in job creation looks like in the real world, you don't look at the stock market, you look at the debt markets. According to a new report by the Federal Reserve Bank of New York, total household debt increased by $191 billion in the fourth quarter of 2025, reaching a staggering, record-breaking $18.8 trillion. Put bluntly, Americans ended 2025 more in debt than at any point in human history. Credit card balances hit a fresh high of $1.28 trillion, a 5.5% jump from a year earlier. And remember, with average credit card rates hovering near 20%, this is the most expensive debt imaginable. Roughly 60% of credit card users are now carrying a balance from one month to the next. They aren't using credit cards to buy luxury goods. They're using them just to buy groceries because their part-time wages haven't kept up with cumulative inflation. And these cracks are turning into canyons. Delinquencies of any duration increased to 4.8% of outstanding debt in Q4 2025, the highest rate since the third quarter of 2017. But the true horror show is happening in the driveway. The auto loan delinquency rate, tracking balances at least 30 days past due, reached 3.88% in the third quarter of 2025, 1.5 times higher than it was during the height of the COVID-19 pandemic. It's actually the highest level since the year after the Great Recession. And if you look at the subprime auto loans, the delinquency rate hit a record 6.6% in January 2025, the highest level since tracking began in 1994. Average monthly car payments jumped nearly 40% between 2020 and 2025, rising from $470 to about $660. People are being pushed to the absolute brink. The financial cushion from the pandemic is gone, savings are depleted, and the New York Fed explicitly noted that these elevated delinquency rates are heavily concentrated in lower income areas. This is the reality of a 15,000 job a month economy. The working class has been in a silent recession for over a year. So, here's the multi-trillion-dollar question. If the labor market is collapsing, if consumer debt is exploding, and if the Fed made a massive policy error based on phantom data, why hasn't the stock market crashed? How is it possible that the S&P 500 is up over 1.9% year to date in early 2026, after gaining 17.9% in 2025? Well, the answer lies in the lag between economic reality and corporate earnings. Right now, the market is still pricing in the soft landing narrative. Investors are looking at that headline unemployment rate, which dipped to 4.4% in December, and are assuming that the low hire, low fire environment will hold. They're assuming that the Fed's recent rate cuts will be enough to stimulate the economy before the bottom falls out. But this balance is incredibly precarious. The revised 2025 data confirms that the so-called consumer resilience that Wall Street cheered about for the last 12 months was not funded by sustainable income growth from new employment. It was funded by dwindling savings and maxed out credit cards, and credit has a hard limit. Now, we have actually seen this exact setup before. In 2009, large downward revisions reflected the hidden fallout from the financial crisis that the real-time data missed. The market eventually faced a violent repricing of reality. When corporate earnings finally reflect this collapsed consumer demand, when the companies realize that their customers are defaulting on their auto loans and drowning in 20% credit card debt, the stock markets will face a brutal reality check. Job creation is the backbone of consumer spending. Without it, the entire narrative of a booming economy collapses, and a weaker labor market increases the pressure on the Fed to panic. If conditions deteriorate further, we aren't just looking at standard 25 basis point rate cuts. We are looking at emergency liquidity injections, or even a return to quantitative easing to stop the system from seizing up. The narrative of a booming, resilient US consumer was built on the foundation of phantom data. An 88% collapse in job creation is the statistical definition of an economy grinding to a halt. The government can revise the numbers quietly on a Friday afternoon, but they cannot revise reality. They cannot revise the $18.8 trillion in household debt. They cannot revise the fact that part-time gigs are replacing full-time careers. And they cannot revise the fact that the Federal Reserve has been setting global monetary policy completely blindfolded. So, when the stock market finally wakes up to the reality of a 15,000 job a month economy, the repricing could be violent. Plan accordingly. But I want to hear from you. Do you trust the government's economic data, or does your own wallet tell you something completely different? Are you seeing this hidden recession in your own city or industry? Let me know your thoughts down in the comments below. That's me for now. Nick signing off. Thank you guys very much for watching, and I'll see you again soon.